for joining us today. And thanks for the Delphi Economic Forum for having us for this panel. I'm Dimitris Psarris. I'm the managing partner of Bain & Company in Greece, and also part of our global financial services and private equity practices. I'm delighted to be joined by my colleague Deike and Diers, associate partner from our Zurich office and a core member of our private equity practice across EMEA. Just a brief introduction that Bain is the global leader in supporting private equity clients and corporate M&A deals. Just a couple of numbers to promote a bit ourselves a little bit. About 40% of our revenue globally comes from our private equity practice. And if we look at the global buyout deals that have happened, above $500 million, since 2000, more than half of them globally have gone through the Bain network. So really have a great visibility on the private equity market. And we're here to talk briefly through Bain's 2023 Global Private Equity Report, share some numbers, market outlook, and really some key trends that we think will be shaping the private equity industry globally in the years to come. So let's dive directly in if you agree. So just in terms of a brief introduction, we're describing in our report 2022 as really a tale of two halves in the private equity industry. We had a first half of 2022, which was really a fantastic first 6 months, continued through an incredible momentum from 2021, which was the industry's best year ever. So really for 18 months, we had record-breaking fundraising deals and exits across all funds and across all geographies. Then in the middle of 2022, at around June, we reached a turning point and a kind of shot that was heard around the world. So the Federal Reserve increased, as we all know, interest rates by 75 basis points. And this was really a strong signal to the market that we would live through a whole new world, that the Fed would be try to tame inflation, and really that interest rates rises would follow. Then the ECB and other central banks followed. And all of this combined with, if you recall, a war in Europe, commodity prices, disruption of the supply chain, led to basically the banks stopping funding leveraged transactions. And in private equity, without bank funding, there are no deals. So big deals went away. And not only we saw deals falling in terms of volume, but also in terms of size. Average deal size fell by 20%. And last but not least, LPs or investors in the private equity world became very concerned about when and if they would get their money back. So really, we saw a second half of the year, and we still see it in the first quarter of 2023, of an extreme slowdown in the private equity industry. Now, before we go into a little bit of detail on this and try and unpack it, I just wanted to give you, to put this a little bit in context. So what makes the current crisis or economic climate, do not call it a crisis yet, different from anything we've experienced before is really a long ongoing lack of clarity as to what it is really happening and when is it going to end. There's no housing meltdown, no major collapses. Really, we don't see events. We don't know when the recession will actually land or end. So really no signals of a definite sea change. And what you see in this chart is basically something related to inflation. So if we look at the average tenure of people working in the private equity industry, basically across all levels, all of them in their careers have seen maximum 1, 2, 3, 4% of inflation. That includes us, their advisors. None of us has experienced 6, 7, 10% of inflation before. We hear some good news that inflation is going down to 6, 6.5, 7%. But still, it's an inflation of 6%. It means prices are going up 6% a year. Asset prices are increasing. So by no means we're done with the problem. And really, this poses significant challenges to all investors on how will they evaluate deals and how will they continue generating attractive returns over time. So end result is what we call the U word, which is a very dreaded term, and the U word stands for uncertainty. And uncertainty, as we all know, is the deal killer, and that is exactly what is happening currently in the market, particularly for the large transactions that require the most leverage. So we've been in 3 days in Delphi with some positive outlook and optimistic tone, particularly from Greece. So perhaps, Deike, we can unpack a little bit the details of our report and then see how we expect this to evolve in the coming years.
No, we're happy to. And if you look at this page, you see a lot of comforting numbers, right? and 654 billion. And global buyout value is certainly not a number to be worried about. I mean, you see 2021 being certainly a kind of an exceptional, an outlier year. But if I now tell you for the 2022 figure that actually 550 billion was committed in the first half, then the message of the slide actually quite turns around. So there was a really dramatic decrease in buyout value and deals in the second half. Interestingly, for the local Greek private equity and corporate M&A market, we saw actually a slight increase, even though deal sizes were going down. And I think that's probably partly also the reason for some of the topics that and the positive themes that you've discussed as part of this forum, and also obviously Greece being a receiver of the RRF. If we now shift to financing, we see that banks actually pulled back from financing large deals. One of the reasons was really a 50% drop in the US and in Europe for the syndicated LBO loan issuance. So that's effectively certainly the large deals. The mid-market actually had quite good deal volumes and value over time still, and that basically out of two reasons. One, particular mid-market deals have good local banking relationships, so they don't need the money coming from the large syndicated issuance from London. And second, also, there were a lot of add-on deals in the mid-market that we see that were actually funded by private credit, which also helped a lot. So you could actually argue that the private credit market was a large driver of the mid-market deals. And if that haven't happened, then we would have seen deal numbers and values to go down even further. Let's turn to fundraising, and let's unpack this picture a bit. Obviously, fundraising has been, over the course of the year, also much more difficult than we've seen before. But if you look over to time, it's actually if you take a closer look, it's actually quite interesting numbers that you see. From 09 and 010, you really have 300 billion on average of fundraising. And that has just increased. So in the past 5 years, we had 1 trillion per year of fundraising, which is quite a significant number. So again, the 1.3 seems not to be worrying. Here again, the timing is a bit the point. Most of the funding that was committed for the 1.3 trillion that we saw in 2022 was actually committed end of 2021 and in the beginning of the years, where we haven't seen some of the macro factors coming to life and impacting some of the decision making. So we believe that in the short term, we would see that the fundraising actually goes down further. But we are still bullish on fundraising overall for the private equity markets, given it's still a very attractive asset class. So midterm and long term, that would come back. Private capital dry powder continues to pile up. So I think if we looked at this page a couple of years ago and thought 1 trillion is quite significant, we're now looking at 4 trillion, of which 1 trillion is actually committed to large buyout. That means there's significant capital to be put at work, and certainly not a risk to have few funding for the deals. So it's not really an argument of whether there is equity to support the deal making, but rather the question is when the deal teams actually get comfortable around the current market dynamics and when and how they want to put this money to work. And certainly, I mean, as a reminder, we all know a good deal is not only made in good economic circumstances, but instability and uncertainty certainly does affect deal making. Maybe another positive picture to keep in mind when you navigate these more challenging times is that private equity has constantly outperformed public markets, and that is across the region. So that's quite a nice statement, and it keeps them, and also one reason for that asset class continue to stay and actually see some tremendous growth. So maybe now we have quite a bit of positive points also to mention, being the dry powder, being the good returns. I think there's also future trends that might be quite interesting to dive into.
Sure. I mean, if we look at the private equity funds, I think just looking ahead a little bit, and apart from the fact that GPs will focus on product innovation, we see already this happening, such as launching new types of fund structure. Really, there's a couple of key trends that are emerging in the industry that we'd like to highlight. We can move to that. Let me start from the left-hand side. So we expect GPs to be tapping into some very significant but less penetrated pools of capital. Now, traditionally, the main investment base for private equity funds has been institutional investors, and of course also sovereign wealth funds. Now, if we look at the total global wealth, about 50% of it sits in the hands of private individuals. Now, if we put that together with the fact that public markets will be limited in the coming years and will constitute a shrinking part of the economy as PE grows, as well as what we saw earlier, that private equity basically has outperformed public markets consistently, there's a large pool of private investors who are really itching to be able to invest in private equity. And on the fund side, retail investors is the, what we also call in the report, the shiny new toy of the industry. I mean, the industry is focusing on finding ways to attract private investors. We see this part of the business growing at 1.5 times faster than the institutional investor allocation base. And we see also some tech-enabled solutions that we believe will accelerate this effort. Then on the right-hand side, we heard so many panels of this in this forum, but I think the private equity industry has a huge role to play in in the energy transition. This is clearly on top of private equity investors' minds because, it provides an opportunity to the funds to do what the funds are good at doing, which is A, provide capital for a big change, but also then drive transformation in their portfolio companies. And really this topic opens a broad arena of new investments across so many sectors. Of course, also poses significant challenges in the already existing companies in the funds portfolios. I wanted to give you one number, which to me at least is quite impressive. So the investors that have committed to the Net Zero Asset Owner Alliance represents $60 trillion of assets. And this, we should note that what this means is that they commit to transition not only their funds, but their portfolio companies to net zero emissions, which includes scope 3 emissions of their portfolio companies. So really the breadth of this change is massive. And working a lot with these clients, we see about 1/3 of these decarbonization projects to fail. So you can imagine that there's kind of a lot of work to be done in this space. Now, an interesting piece of information as we are moving now on to how corporates and operators can kind of navigate these uncharted waters. This is the last fact or numbers we'll show to you today, so we promise, which is the fact that if we look at the industry for the last decades, returns have come largely from multiple expansion, right? So, and less so by revenue growth and margin growth. So really, this is now changing because in the current interest rate environment, there's no way we can see prices appreciating so much. In fact, all of our LBO models includes assumptions of 8 to 10%. So funds are under pressure, and particularly when it comes to portfolio companies that the funds acquired in 2021, which was really the peak year for the industry. So really that creates a new pressure for the funds to think of ways on how to drive margin growth, margin expansion, which will be the main driver of growth in the future, especially as inflation is eroding asset prices. So given that returns will increasingly have to come from earnings growth and not multiple growths, how can companies navigate that, or operating partners of companies? So if we look at any past downturn in the industry, history has shown us that the winners after the crisis are really the companies that just correctly assessed all scenarios, mitigated the risks, and really continue to invest. And they need to continue to invest to create a bottom line impact, particularly in this time. So just some areas where we see companies working on, for example, lots of opportunities in investing in automation to mitigate labor shortages and also the demographic problem that we're facing across the world. Investing in supply chain redundancy and security. I mean, we've seen some examples, for instance, Tesla opening up plants in Mexico, or we're seeing major industrial companies and logistics companies investing in software to create digital twins so that they're able to kind of simulate live their maritime and road-based kind of supply chains. So really a lot of investment in this space. The third is reworking a little bit the capital structure. So companies need to trying to lock in favorable rates given the environment wherever possible, but also keeping an eye on their overall leverage levels. Then we have the point of focusing on the customer. And of course, we're talking about the overall value proposition, but more importantly, at this context, trying to target, review your customer segmentation, try to target customers potentially with a little bit of lower price sensitivity. And I think last but not least, and quite importantly, in fact, companies need to build their organic growth story. As we saw in the previous page, we've all been very spoiled by multiple expansion returns. In the current environment, in the current interest rate environment, and the relatively slow GDP growth that we're facing, any strategy and any growth will have to come at the expense of competition. So market share gain is the name of the game. So strategies to gain market share, add adjacencies, create new addressable markets is really something that companies will have to start thinking about, and a tool for the most successful ones. So really, to wrap this up, we really believe that accelerating out of this recession is really about taking a fresh look at our companies or our portfolio of companies' competitive position, and plotting how to use the downturn to actually gain market share, just to repeat myself one more time. So identifying those opportunities now and really having the courage to invest behind them is really what we think will generate superior performance for those companies all the time and the funds themselves. And we're right in time, as if we're. Thank you very much. I hope you found this.